A closing bell has just rung on Wall Street, and the big story tonight is clear. The AI high flyers finally hit some real turbulence. I'm Grant Mercer. This is Storm Stock Solutions, and we're here to bring some clarity through the chaos of today's market. Let's start with the day's defining move. According to reporting from MarketWatch's Brittany Nguyen, Nvidia, Broadcom, and a whole basket of AI-related names sold off sharply as investors started questioning the plumbing behind the AI boom. The concern isn't just about demand anymore. It's about the debt being raised to finance these massive AI data center buildouts by players like Oracle and CoreWeave. When traders see heavy borrowing tied to a hot theme, alarms go off about sustainability and balance sheet risk. That dynamic helped pull a lot of the AI complex lower and weighed on broader tech sentiment into the close. Stepping back to leadership and strength, the tone was more defensive and income-focused. Philip Van Dorn at MarketWatch highlighted a group of 10 widely loved dividend stocks looking into 2026, many of them energy names with yields of 4% or more after getting hammered alongside weaker oil prices. The story there is simple. High current income plus the possibility of a rebound if energy stabilizes. You could see that in today's tape as traders showed renewed interest in classic dividend and value plays while trimming some of the crowded AI growth trades. It's the kind of quiet rotation professionals watch closely heading into a new year. We also saw continued chatter around emerging markets as a counterweight to US tech. Christine Idzelis at MarketWatch points out that emerging market stocks have broadly trounced the S&P 500 this year, one of 2025's biggest surprises. The closing bell question is whether that outperformance can persist if US growth cools, or if the AI unwind spreads. For now, M remains a key part of the where else can you put capital conversation as domestic leadership gets more concentrated and more volatile. On the flip side, the pressure today was squarely on that AI and data center narrative. Beyond the headline declines in Nvidia and Broadcom, the idea that AI infrastructure might be overbuilt or overlevered in the short term is what really hit sentiment. Investors are recalibrating. Instead of AI at any price, the focus is shifting to balance sheet strength, cash flows, and who actually monetizes AI versus who just funds it. That's not a full-on bubble burst call, but it is a reminder that even the hottest themes can face shakeouts when the financing side starts to look stretched. We also had some fascinating crosscurrents within the megacap universe. Emily Berry's reporting on Eli Lilly outpacing Nvidia in recent weeks, and historical patterns suggesting Nvidia sometimes claws back relative performance afterward, added nuance to today's moves. It underscores that leadership at the top of the market is no longer a one-way trade in semis and AI. Healthcare, pharma, and selective digital platforms like Meta, which also featured in a separate piece as a potential first-half standout, are all jockeying for that core holding status. Beyond the tickers, there were a few under-the-radar stories worth putting on your watch list. On the personal finance side, Quentin Fottrell's columns dug into emotionally charged issues. One about an estranged husband taking over a deceased cousin's home, another about a 61-year-old with a sizable 401k wrestling with how much financial support to give an adult son. These don't move indexes, but they speak to real-world behavior around housing, inheritance, and intergenerational money, all of which ultimately influence saving, spending, and long-term market flows. Beth Pinsker's piece on 401k plans nudging participants in their 50s toward annuities is another sleeper theme. It reflects a broader push by employers and policymakers toward lifetime income options inside retirement plans. If that trend continues, it could gradually redirect more assets toward insurers and fixed income-like products over the coming years, changing the backdrop for both bond and equity demand. And in media, Lucas Alpert's report that the Oscars will move exclusively to YouTube starting in 2029 is a slow-burn signal for the ongoing shift from traditional TV to digital platforms. Investors will be watching how legacy broadcasters, cable models, and streaming players adapt as one of the last big live TV events heads online. Looking ahead to tomorrow's pre-market, traders will be focused on whether this AI unwind was a one-day air pocket or the start of a deeper de-risking in growth. They'll also be watching if money continues to rotate toward dividend payers, value, and emerging markets, and how any new headlines around funding costs or corporate debt might feed into that story. We'll break all of that down for you before the opening bell. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.